Well, good Friday afternoon. This is Rich Morrison, and welcome to the latest edition of the Thinking Cap, where I'm going to talk about the soybean market today. Soybeans have certainly been hit the hardest over the last couple of months. There certainly are some fundamental reasons for that, and we'll dig into that here in just a moment. So, looking at the U.S. situation in soybeans, back in January 12th, when we had the latest USDA report, yes, it was bearish. USDA added 35 million bushels to the production, added 35 million bushels to our ending stock number. But really, for the fourth straight year, we're not looking at any major stock buildup or anything. So, still below 300 million bushels. That continues to be fairly snug. But the big story continues to be South America. And if you go back to October and November, it was hot, it was dry. They were planting the beans in dry dirt, didn't get a lot of rain on those early crop beans, and started struggling. USDA started out predicting a 163 million metric ton crop. That number has come down. USDA will be out next Thursday with its updated number. You can currently see USDA's projections, the second column from the right. They're at 157 million tons back in January. But the thing is that once we got into middle of December, the weather pattern started to change. And even though we couldn't get back some of those early losses in Brazil, the rain stopped the bleeding, coupled with looks like it's going to be a really good crop potentially in Argentina. The column on the right shows my combined numbers, and I'm being a little conservative on the Brazilian crop at 145 million tons. I've seen numbers from 145 to 150 here this week. The Argentine crop, one of the big analysts down there estimates that crop at 52 million tons. So if you use those two numbers, this is going to be a record bean crop down there. And so while early on people were talking drought and this 145 dropping way down into the 120s, 110, don't think that's going to happen. And this has totally flipped the bean market on its head. And if you look at the world stocks to usage numbers, the University of Illinois put this out just this week. Stocks to usage at the world level, not just US, but at the world level, is going to grow to the highest point since 2019. And that's when we had a record US carry out that year. And so as stocks continue to build, that's going to be a problem. Now, why? Well, if you look at rainfall in Brazil over the last 30 days, this area up north into Mato Grosso, Goiás, some of these eastern states have started getting good rains. That rain was down south early and it's moved up into the heart of the country. And if you look at the latest forecasts, there has been a little concern about Argentina being a little bit dry. But if you look over week 2 on the right, they're supposed to catch rains. Brazil's supposed to catch rains. If there's any concern at all, it may just be over the fact that they'll get a little too much rain and not be able to harvest the crop. But otherwise, it looks like rain makes grain, and that's certainly been what the market's been looking at. And if you look at the non-competitiveness of U.S. beans, the Brazilian beans are in the green here, and the U.S. is in the pink. This shows values delivered to China. And so U.S. beans in March are $2 more expensive than Brazilian beans. Do you think China's going to buy any U.S. beans at a $2 premium? Probably not. The only reason they would do that is if Brazil had trouble harvesting beans and logistics became an issue to where they had boats sitting around, couldn't get them loaded, had to send a boat to the U.S. Now, China's got its own problems it's dealing with right now. This is a headline at the top from the Wall Street Journal at the beginning of this year, talking about the Chinese economy limping into the year. They've had 3 straight quarters in 2023 of negative GDP. Their exports are down, their imports are down into that country. We're talking inflation in the West. They're talking deflation over there right now and can't get things kick-started again. You may recall, and I've been telling this story, but President Xi came to the United States back in November and talked to President Biden in San Francisco. But the more important visit in that trip was that evening when he met with the CEOs of, I think, 40 plus companies in the United States, trying to get them to bring cash to China to kickstart the economy. And so that's been a problem. And if you look at feed values in China right now, meal, corn, rape meal, all of these markets are in a free fall. China is actually telling producers over there to start cutting back on hog numbers to try to elevate the hog prices. Well, that's not a good thing for feed demand. And so U.S. loadings have been disappointing. You can see in the black line, the last several weeks, our bean loadings have been very disappointing. And we're moving up to that window right now where most of the shipping then starts to go out of Brazil. Our export sales number that came out yesterday morning, 166,000 metric tons, was the low of the marketing year. So you can guess China isn't buying any beans from the United States, and why would they? At a $2 premium, they're going to try to wait another 3, 4, 5 weeks and start loading boats out of South America. And so here's a snapshot of what the hedge funds have been doing in the soybean market. And I like to start out at least looking at the purple line on here, because the purple line shows, if you go back to August of 2020, this is kind of when all the magic started, and the hedge funds started ramping up buying in the soybean market. They did in corn, they did in crude oil. Commodities were a hot item. And they built a huge long position of 240,000 contracts. That was a record long by October, and gave us a whale of a rally in the bean market. These folks stayed long through 21, through 22, even into January, February of 23. A year ago at this time, the red line, these hedge funds were still long close to 200,000 contracts of beans. But what happened shortly after that was there was enough rain to make that Brazilian crop last year a record. And even though the Argentine crop was cut sharply, that big Brazilian crop started to hit the market, and these people started running for the woodshed. And they liquidated that entire long position by the end of May. And I'll show you the futures chart here in a minute what happened. Since then, we had a U.S. weather rally in the summer where the funds bought. We had another weather rally in Brazil in October, November. But once that precipitation started moving north up into the center of the country, these people have been dumping on the bean market. And as of this afternoon's report, these hedge funds are now short 108,000 contracts of soybeans. That's the lowest position they've had on this date. And they're knocking on the door at a record, the second shortest position they've ever had. The shortest was back in 2019 when we had record US and record world stocks to usage numbers. And so I've been telling folks that if you're a pessimist right now, you'd say, woe is us, beans are plentiful. It's going to be hard to turn this thing around. If you're an optimist, you look at this and say, what are the odds that these people continue to sell at this point? Are they comfortable adding to their short positions? And I think that this is probably what's going to dictate what happens to the markets here, over the next several months. Do these people have a desire to come out of this short position? Or are they willing to stay short, knowing that you've got the Brazilian farmer about ready to harvest a huge crop? You've got the Argentine farmer about ready to harvest a huge crop. You've got the U.S. farmer was still owning beans. You've got the U.S. farmer about ready to plant an increased acreage number this spring. So there's a lot of reasons why these people have been right, and a lot of reasons why they may decide not to panic and buy back yet. But if they did, if something happens where China blows into the market all of a sudden, or it gets too wet or too dry in Brazil, these people have got over 100,000 contracts short just to buy back to get back to zero net position. And so I think this is the story for the year. What are the hedge funds going to do? And as we look at March soybean futures tonight, we made a new low, traded to our lowest level, 1186 and 3/4, the lowest level since back at the end of May, when the hedge funds liquidated that long position last year. I continue to really look for two things on this chart. Number one is this 9-day moving average line, the red line at 12.15. I think it's critical to get consecutive closes, and we did a week ago, but it is really critical to try to close a couple times above that to change the trend of the market and get back, above the 20-day moving average at 12.25, which we haven't done since back, really since back in November, to speak of. So to turn this market, you've got to get a few things to happen here. You just need 2 or 3 consecutive higher days. If you got old crop beans, I've been targeting this chart gap at around 12.90. Probably would fade that by a quarter just in case, or a nickel just in case. But maybe if we pop back to that area, might be an opportunity to sell out the rest of your old crop. If you want to stay in the market, go buy some out of the money calls. November soybeans, couple of things to look at, very similar looking chart. We did make a new low here today, 1270 and a quarter, lowest we've been since the 1116 and a quarter back at the end of May. And I still think that that is your risk in this market as we go forward. If you happen to be a buyer of the margin protection policy using 1295 as your base price at 95%, that would be in the money right now if we have a normal yield in our counties this year. So that looks like a pretty good move at this point. I would be all over having some offers in the market right now up under this chart gap at about 1230, probably about 12 and a quarter, maybe even $12 if you wanted to get started or catch up or whatever the case is. And that happens to be a little bit below the 50-day moving average, which again, maybe not a bad place to have some offers, but not a good close for the week. Certainly at the low of the week, indicator lines, RSI, stochastics, all turning down as well. So respect the risk here, 1116 and a quarter, that low from back in the spring certainly could come into play at some point this year. I read another analyst the other day suggesting 1050 as a potential low. So, we pop back up here. I'm thinking of marketing up to 40% of my expected production, something with a 12 in front of it at this point. The last thing I do want to show you here is the stocks to usage to price chart, and a couple of things to point out. U.S. numbers have been relatively tight in the stocks number, and that is what's caused our double-digit prices that we've seen the last 3 to 4 years. We do expect with more acres this year that stocks to usage number could grow a little bit. USDA in its baseline projections was talking 1130 market year average price. Again, I did mention someone else was talking 1050 potentially. So I've drawn these extra blue lines in here. But the other thing I would point out on this chart, compared to a decade ago, what happened back then for different reasons. But when we made a record high back in 2012, the following 2 to 3 years, you saw prices trade lower. Because what happens when you have high prices? You curtail demand, especially export demand, and you increase acres. And once again, we have given Brazil a signal to increase acres with these high prices, and that's what they're doing. I'm going to guess they're going to do it next year. Shoot, the United States is expected to increase bean acres this spring. And so that's not a great combination when, stocks are already big. If you start adding acres, certainly you would expect prices to trend lower in the year ahead. So some considerations for soybeans, and I'll talk about this next week in our aftermath webinar, but I want offers in. I mentioned 1290 March, 1230 November. I think those would be some really good targets if we go back up and attempt to fill those gaps. Get the offers in, let them work. Consider SCO, and we'll talk more about the farm program in the future. But if you're concerned about prices trending lower, especially, consider the SCO in addition to your multi-peril policy, because SCO's price, even though the prices are trending lower, it still looks like that insurance price is going to be roughly 70 cents or so better than what the ARC price is. I'm not talking about corn, I'm just talking about soybeans here. If you decide not to buy SCO, then sign up for the ARC program over PLC. The other thing I want to look at this year, in addition to selling, and I've been suggesting maybe you forward sell if we get a rally, 35 to 40%, maybe even up to 50% of my expected production. But utilize ECO, or consider that at the 95% level as a put option. We talked about this last year. And if I'm afraid that, we could have a bigger price drop, 10, 15% from where the price gets set here in February, ECO really works as a put option. And yes, it does have bushels in it as well. It's a revenue policy. But at this point in time, if I'm really concerned about that multi-year drop in price again, then I want to look at the ECO policy really hard. If you decide it's too expensive, consider cutting back on your dollars of coverage. I would consider that instead of buying the 95, 100, maybe you consider 95, 50. View that as if you're doing it on 50% of your acres rather than on getting paid 50 cents on the dollar. And if I did ECO, therefore on 50% of my acres, forward sold 50% of my crop, I think that's a great plan to consider here for this year. So with that, I appreciate you taking the time to listen to my Thinking Cap video. If you've got questions, feel free to shoot me an email, whatever the case is. Hope you have a great weekend, and I look forward to talking to you all again very, very soon.